Hi, I'm Dennis Rodkin. I write the Deal Estate column for Chicago Magazine, and this is DEQs, where I answer real estate questions. A question that's on a lot of people's minds right now is, how will the new mortgage rules that were laid out by the Consumer Financial Protection Bureau last week change the cost or the process of getting a mortgage when they take effect in January 2014? There are a few ways that these new rules may slow down or make more expensive the act of getting a mortgage. But in both of those, it's a very slight effect. It's not going to dramatically protract or make massively more expensive getting a mortgage. However, these are things to watch out for because they're going to kick in when the new rules kick in January 2014. Let's first say that these regulations that are coming in seem very good. They're designed as a response to the overly loose lending in the early part of this century, in the 2000s, and what they did not do when writing these rules is write them to be so overly strict, to be such a huge overreaction that lending became enormously more expensive or it would take a much longer time than it has in the past. But let's look at how these things will change. A jumbo loan may become more expensive, slightly more expensive. A jumbo loan is a mortgage of $417,000 or more, a very common amount in an expensive market like Chicago. A lot of people have jumbo loans. And here's the thing, jumbo loans will not be counted in the qualified mortgage packages that are backed by Fannie Mae and Freddie Mac, the largest guarantors of mortgages. So banks aren't able then to sell off jumbo loans to a secondary market. That means that their funds for lending don't get replenished when they sell off the loan, because they're not selling off the loan. But more important than that is they're going to have to manage and profit from that loan over the long term, not just at the time of origination. So they're going to become more cautious about lending jumbo loans. They're not going to stop, but they're going to become more cautious. And in lending, that means they're going to charge more. Probably not a whole lot more, because these are generally affluent buyers with good credit ratings, et cetera, so it's not an enormous risk. And mitigating that risk to the bank is that jumbo loans, though they're not backed by Fannie Mae and Freddie Mac, though they won't count in the qualified mortgage package, they still will be subject to, as all mortgages will be, the ability to pay evaluation. The lender has to be sure that your entire credit package, you can't have more than 43% of your pre-tax income going to debt, student, car, mortgage debt. You have a good ability to pay over the long term of this loan. You have a good employment history. All that has to be evaluated. So these loans, though they aren't backed by Fannie Mae and Freddie Mac, have gotten the same stress test that those kinds of loans would get. So that at least mitigates the risk to the bank that these loans might fail. Now, for some other lenders, it's not a question of the price going up so much as it is the process getting longer. If you've borrowed in the past from a credit union and you plan to again, you may find that the process is slower and stricter after January 2014 when these new regulations come in. Credit unions, for the most part, operated very, very cautiously when the other lenders were all out partying. So they're considered really faultless in the housing crash, but those same ability to pay requirements that we just talked about will apply, because they apply to all mortgages, will apply to lending by credit unions. So that's going to slow down the paperwork for mortgages from credit unions. And then there's another group where you may find the price going up, but just slightly. If you buy from a production builder, if you've bought a house from a big subdivision builder, in the past, often the builder could refer you to preferred vendors and you'd get a little bit of a discount. That could be for title insurance, it could be for the legal process of settlement, those sorts of things. And by going to the builder's preferred vendors, you got a slight discount. Here's the problem. The new rules don't allow fees from the lender to get any higher than 3% of the purchase price. There are sometimes ownership connections between the builder and the preferred vendors, and so the builder will be concerned that if you go to those vendors, then your fees get up to more than 3% of your purchase price. So they're very likely to sever those connections, no longer provide preferred vendors, so you don't get those discounts. Those discounts have been very slight, but again, it's a little bit of an increase that you could feel. Now, there's one unknown that could affect the way mortgages are handled, but it hasn't yet been decided. It's the question of how big a down payment is going to be required. That was not in this package. It's supposed to come later this spring. It's being discussed by 6 federal agencies, and we don't yet know when it's going to come down. But the question is, will you be required to put down a 20% down payment when buying a house? If that becomes the standard, that's pretty steep. It has in the past been 5 or 10%. Some people put down even less during the loose lending climate. But if you're required to put down 20% before buying, then a lot of people will either not be able to enter the market for several years while they're saving it up, or decide not to enter the market because they don't have the ability or the interest to save up, let's say $100,000 to put down on a $500,000 house. Those rules are still being worked on. We don't yet know the answer, but when we do, that will answer one of the big questions that's hanging over the future of the mortgage process. Thanks for your question. Send me more at dennis@rodkin.com.